closer look on how the global markets performed this week and the chaos. I'm joined by Ayal Shmilovich, and he is the Managing Director at Gerber Kawasaki Wealth and Management. Good to have you with us from Santa Monica. I know the weather there is always good, but the stock market weather has been pretty awful this week. And I have people asking me what's going to happen next, and of course we have our own opinions. What do you think is going to happen in the next couple weeks here?
Well, the Santa Monica weather is a little gloomier today, maybe to reflect the markets. But you know, there is a lot of stuff going on with inflation, and ultimately, you know, oil prices are really creating a challenge for the market. So, you know, over the next couple of months, we're not really sure where the market goes. You know, we don't tend to do market timing predictions, but we do think that we are not in the recession camp. You know, China is stimulating their economy, hopefully bringing their people back online. Hopefully that increases global spending. You know, GDP forecasts have been cut here, but we still think that there's room for the economy to run. The economy seems strong. You know, people are spending money.
But how can that be? Amazon just told you that rising prices are hurting them. Walmart is saying the same thing. Target, I mean, every single company is saying the exact same thing, that rising prices are hurting profits and it's hurting the consumer. We can't just ignore that.
No, absolutely not. There's no question that inflation and supply chain constraints are hurting everybody. You know, margins were extremely good coming into this year. They've obviously been hit a lot since all of this has happened. Amazon, Target, Walmart, you know, they're all great examples. But revenues are still rising and earnings are still up 9+% on this year. So while the economic outlook is not as great as we would have liked it to have been, while obviously the war in Russia and Ukraine has exacerbated an already, you know, bigger problem that we've had with inflation, and the Fed raising rates is obviously not great, but earnings are still rising and GDP is still rising and not sinking back into recessionary measures as far as we're concerned. So we got to see if the Fed can land this soft landing as they, you know.
But here's the other problem. 6 months ago, the Fed said inflation was, remember, the T word, transitory. And I was saying that they're getting it wrong. It's not transitory. It's everywhere, from car prices to, I mean, I don't know how you don't see that.
Sure.
I think the Fed screwed up. Now they're playing catch up, right? But has the damage already been done, and can the Fed fix the errors of the past?
Well, you know, we hope so, but you know, there is damage for sure. But you know, inflation, as far as we're concerned, we think is peaking. You know, we saw a little bit of a slowdown, not as much as we would have liked to, but hopefully over the coming weeks and months, hopefully with China coming back online, supply chains will ease a little bit, shipping costs will ease. We think that we're seeing sort of an easing in pricing. You know, prices as far as real estate comes in the States is coming down. So the economy is slowing, but we don't think going into recession. We think this will work itself out over the coming year. But once again, we are not in the business of predicting what's going to happen over the next 3 months, but we do see this dislocation in the markets, especially in the tech sector and areas that we think are great companies, as an opportunity to buy for long-term investors.
Okay, so let's start buying. I'm going to give you $100. We're going to start. Where do we start? We saw consumer staples, discretionary. I mean, every sector has basically been hit, right? So where do we put our money?
Yeah, I mean, we're partial to technology companies over time. You know, we look at companies like Tesla, like Nvidia, that have been hurt 50%. Companies with great businesses, obviously, you know, slightly higher valuations, but we think tremendous earnings and growth and revenue potential over the next 3 to 5 years. And when we buy investments, that's where we start. We look at 3 to 5 year time horizon. So we think stocks like that, and obviously the Googles, the Apples, and the Microsofts of the world that have gotten hammered in spite of having, you know, some of the most amazing businesses out there. We think these are great places to start with new money and dollar cost average into the market.
Fair enough. But let's say I'm one of your clients and I'm getting old and thinking about retirement, and I'm worried over the weekend looking at the markets. What are you worried about?
Yeah, listen, inflation is a concern for sure. There's no question about that. The Fed raising rates, and it's not a zero chance that there's a recession. There is a chance of recession. So what we're telling our clients is this is the time to be, you know, focus on core positions. Speculation is eliminated. Make sure you have cash for whatever you need over the next 12 months, and that's what we've been doing for our clients. You know, bonds have not helped us in this market. Traditionally, they have in the past. So raising levels of cash and ultimately making sure that they have what they need and that their investments are in line with what they're actually trying to accomplish. And hopefully over the next year, we'll be able to, you know, right the ship and then things will get back to normal.
All right, I hope you're right. Ayal, managing partner, Gerber Kawasaki. I guess we should have the extra cash to pay for gas, so to speak. Have a great weekend. Thank you.
Thank you.